Welcome. In this video, Zbcn coin will rise 10x. What is the reason? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
Uptrends are formations in financial markets where prices move upward in a consistent direction and are considered an important reference point in technical analysis. This trend line is typically drawn by connecting the low points and visualizes the overall direction of the price. The uptrend itself indicates that buyer pressure continuously outweighs seller pressure, with the price regularly forming higher lows and higher highs. Therefore, investors look for buying opportunities when the price touches this trend line, as historically, the trend line acts as strong support and the price is likely to bounce from this level. In the described scenario, the price is said to be touching the uptrend line. This is a technically critical point. When the price touches the uptrend line, considering previous price movements and market psychology, the probability of a bounce from this level is quite high. Investors and traders expect the price to move upward again at such contact points, because the trend line represents where buyers re-enter the market. The price touching the trend line attracts buyer interest and leads to position openings, which supports further price increases. The uptrend line also reflects market psychology. When investors see the price approaching this line, they anticipate the continuation of the trend and adjust their positions accordingly. This behavior increases the likelihood of the price bouncing from the trend line. The trend line functions like the market's natural equilibrium. Buyers step in at this point, selling pressure temporarily weakens, and the price continues to move upward. Technically, a bounce from the uptrend line can also be interpreted as a short-term buying signal. This signal shows investors the strength and sustainability of the trend. A bounce from the trend line allows upward momentum to increase, attract new buying, and enables the price to reach higher levels. Especially if the trend line has been tested over a long period and remains valid, a bounce from it is considered a much stronger and more reliable move. An important factor to note is the strength of the trend line and the manner in which the price makes contact. A gentle approach to the trend line with a responsive bounce indicates a healthy trend. Conversely, a rapid and aggressive drop toward the trend line may carry a risk of breaking it. In the described scenario, the emphasis is on the price touching the trend line and bouncing, which is a positive sign for the market. A bounce from the uptrend line, when considered alongside other technical indicators, creates an even stronger signal. For example, if the RSI indicator is in the oversold zone and the price bounces from the trend line, this supports buyer dominance and upward momentum. Trend-following indicators such as MACD showing positive crossovers further increase the likelihood of continued price increases after the bounce. The price bouncing from the trend line is also significant from an investor psychology perspective. When the price approaches the lows in a long-term uptrend, it usually does not create panic or concern, because investors recognize these levels as strong support points. A bounce from this level restores confidence in the market and leads buyers to increase their positions. This chain of behavior contributes to the price rising again and the continuation of the trend. High trading volume also enhances the effectiveness of such bounces. An increase in volume during the price's bounce from the trend line indicates that buyers have entered the market strongly and selling pressure is controlled. This supports the price reaching higher levels along the uptrend and confirms the trend's strength. In conclusion, the uptrend line is a critical level that indicates the overall direction of the price and provides support. The price is currently touching this line, and a bounce from it is a strong signal for the continuation of the upward movement, both technically and psychologically. When the bounce from the trend line occurs, the price can sustain its upward trajectory, providing significant profit opportunities for investors. The continuation of the trend confirms both short-term buying signals and the strength of the long-term trend. However, we cannot base analysis solely on trends, so let's examine the other metrics as well. Stay tuned.
The ATR indicator, or average true range, is a technical tool used in financial markets to measure volatility and shows how widely price movements occur. When the ATR value for an asset or coin rises, it indicates that market volatility has increased, meaning the price has started to make larger swings and may experience higher movements in a short period. The ATR is considered an important guide for predicting how far a price can move in a single-direction trend, or how much it might drop during sudden pullbacks. In this context, the ATR line rising at the current price level shows that the struggle between buyers and sellers has intensified, market energy has increased, and therefore the price may move more sharply and quickly. The rise in ATR is also critical from an investor psychology perspective. When market volatility increases, investors follow short-term price changes more closely, accelerating their trading decisions. For example, if the price approaches a support or resistance level and the ATR indicator is rising at the same time, the likelihood of the price bouncing or breaking from that level increases. High ATR creates uncertainty in price fluctuation in the market, prompting traders to set stop-loss levels more carefully and review their risk management strategies. From a technical standpoint, a rising ATR increases the potential for sudden price surges. This is particularly important during trend movements, as a rising ATR in an uptrend suggests that the price may reach higher levels in a short period. Similarly, ATR increases in a downtrend indicate that the price could fall quickly to lower levels, raising risks for short-term investors. When used to measure daily, weekly, or hourly fluctuations, ATR emerges as a reliable tool to understand market energy and the strength of the current trend. The rise in ATR also affects market liquidity and trading volume. As the price becomes more volatile, investors open and close positions more quickly. This leads to wider price swings, sudden upward or downward movements, and an increase in short-term profit opportunities. For instance, if the price of a coin moves within a stable range while ATR rises, it signals that the price may break out of this range and make a sudden upward or downward move. A rising ATR supports trend continuation and potential movement range. If the price is in an uptrend and the ATR line moves upward, it indicates that the current trend is being reinforced and that longer upward moves may occur. Similarly, in a downtrend, a rising ATR suggests that the decline may accelerate and sharp price changes are possible. Investors can manage their risks and better evaluate potential profit opportunities by monitoring the direction and magnitude of the ATR. The rise in ATR also makes setting stop-loss or take-profit levels during sudden price movements critical. Increased volatility requires traders to protect their positions or exit at the appropriate time. Therefore, when ATR rises, careful and strategic action is necessary because the price can change within a wide range in a short time, potentially resulting in unexpected gains or losses. In technical analysis, a rising ATR is also used to anticipate possible trend reversals or breakout movements. When the price is compressed within a range and ATR increases, it usually signals that the price is about to break this compression and start a new trend. Traders can use this signal to predict the breakout direction and open positions accordingly. In conclusion, a rising line in the ATR indicator indicates increased market volatility, the potential for larger and faster price movements, and active participation from both buyers and sellers. This presents both opportunities and risks for investors. Analyzing how the price reacts within the current trend or at support or resistance levels alongside the ATR's direction and magnitude allows forecasting of short and medium-term market behavior. Increased price volatility suggests that upward or downward trends can be more effective and rapid, enabling investors to strategize accordingly to optimize both risk management and profit potential.
Price movements in financial markets are closely linked to historical performance and market psychology. If an asset or coin has experienced a certain upward movement in previous sessions and then entered a horizontal consolidation phase, this sideways period can be interpreted as the market gathering strength and accumulating energy for the next upward move. The horizontal movement following a prior rise reflects a temporary balance between buyers and sellers. The market is preparing for the next significant move, and investors typically adjust their positions during this period, expecting the price to move upward again. In the current scenario, with the price in another horizontal movement and considering that similar horizontal phases in the past have been followed by strong upward trends, the likelihood that the price will complete this sideways phase and initiate another rally is quite high. Technically, horizontal movements are usually periods where support and resistance levels are tested, and market participants form a consensus on the next direction. Even if no significant increase or decrease in volume is observed during sideways trading, buyers and sellers establish their strategies during this period, setting the stage for the next major price movement. Previous upward trends serve as important reference points, indicating potential market strength and trend direction.
If the price repeats a similar upward movement after a horizontal phase, it supports market dynamics and investor reactions, potentially signaling dramatic gains such as 10x. Psychologically, when investors see that an asset has achieved strong upward movements in the past, they develop positive expectations for it. When the price enters another horizontal consolidation period, investors view it as an opportunity and are ready to buy if the trend continues. This behavior creates a chain reaction that supports the price rising strongly again. Market participants' expectations, based on past performance, make it likely that the price will mimic previous rallies, potentially resulting in 10x increases. From a technical analysis perspective, horizontal consolidation periods are times when the price accumulates momentum and gathers the necessary energy for trend continuation. These sideways phases can be defined as periods when buyers strengthen their positions and sellers experience a temporary pause. The sideways price movement reflects the market's current balance and the foundation needed for trend continuation. If the price follows a horizontal phase with a movement similar to the previous rise, this rally may be stronger than the prior one in terms of both volume and momentum, potentially yielding gains of around 10x. Previous rises and the current horizontal movement provide investors with important clues for predicting price behavior. If similar horizontal movements in the past were followed by strong rallies, investors adjust their positions according to this pattern. Stability during the sideways phase indicates that the trend has not broken and that buyers remain active, allowing the market to accumulate the energy required for the next strong move. This energy enables the price to rise quickly again, making a potential 10 times increase possible. Additionally, volatility usually decreases during horizontal movements, allowing the price to move steadily between support and resistance levels. Low volatility reduces the likelihood of sudden and unexpected moves, but it also indicates that the price is gathering energy for the next significant movement. If the price remains horizontal and then releases this energy in an upward breakout, the movement may resemble the previous rally and create dramatic profit opportunities for investors. From a strategic standpoint, horizontal phases offer critical opportunities for investors. By opening positions during consolidation, investors aim to maximize gains from trend continuation. If the price shows the potential for a movement similar to previous upward trends during a sideways phase, it is ideal for buyers entering the market and supporting the trend. This scenario increases the likelihood of a potential 10x rise and sustains market momentum. In conclusion, the probability that the price will follow a rise similar to past rallies is quite high. Horizontal consolidation periods are critical phases where the price accumulates momentum and the energy necessary for trend continuation. When investor psychology, technical indicators, and market dynamics are considered together, the likelihood that the price will repeat a previous upward movement supports a scenario capable of a potential 10 times increase. As the price gathers energy during this horizontal phase and rises again, it can exhibit a strong rally in terms of both momentum and volume, creating significant profit opportunities for investors. Completing this sideways phase confirms trend continuation and market strength, making a 10x rise similar to previous upward movements possible.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.